So our first speaker is Daniel Salzner. You've got 2 photographs here, Daniel. That wasn't so we could compare haircuts for you. That was because the photograph that was sent over, the smaller one, was such poor quality that when we sort of tried to make it larger, it looked like it just, you couldn't actually see it. It fell to pieces. So I found that one on the internet from somewhere. I think that might have been from your uni days. No, sorry, that's your Twitter one. There was one from your uni days that I must admit was so embarrassing that I thought I can't really do that to you. So, as I mentioned before, what we've sent out to you is just an example of the criteria. Again, that's going to load up any second, but it's taking an absolute age. So you should have received these 2. So if you can just get those ready, and Daniel will be going through some of those. That slide still hasn't appeared yet. So there it is. Okay. And what we always do with each of the speakers is give you a little bit of background on them and also an interesting fact. And hopefully when this appears, I'll be able to give you the interesting fact on Daniel. Today's a bit of an international, got a little bit of an international flavour, as you'll realise with the first 2 speakers, because, and again, I do wish this would appear, so I don't want to get it wrong. So Daniel grew up in Vienna, moved to California when he was about 14 years old. If he sounds a little bit like Arnold Schwarzenegger, that's probably why. You're all now going to be hearing him speaking as if he was in the Terminator, no doubt, when he's talking away. Came to London 2 years ago to attend the London Business School and has been working for Selina Finance for the last year. And his interesting fact is that he is a licensed skydiver. I didn't know you had to be licensed to be a skydiver. I thought they just chucked you out of a plane, but he's licensed. So what we'll now do is I'll just switch over the slides onto Daniel's, which I'm hoping I can do without putting my glasses on. No, I don't want to do that. That's InterBay. What's happened there? No, I do need my glasses because I can't find the right. Okay. I did say that if anything was going to go wrong, it would go wrong. I need to click on the menu. That's why. Right. Okay. So let's try this one. Daniel, over to you. Apologies, everyone, for that. I need to put my glasses on, obviously. So Daniel, over to you, and I'll see you in about 20 minutes.
Great stuff. Tony, can everyone hear me? Am I on loud?
Yeah, we can. I can hear you fine. I should imagine. Yeah, I should imagine.
Perfect. Yes, I think people can hear me.
I can't hear you. So
super. Thanks, guys. Thanks, Tony, for the introduction. I think probably now you guys can't unhear what Tony has mentioned about the Arnold comment, but happy to give you guys a bit of extra voiceover here, and hopefully it's okay to listen to. But yeah, so happy to walk you guys through, I guess, some of what we do here at Selina. Some of you might have heard of us. We've been around for give or take the last year. We're a digital lender based out of London. And what we effectively offer at the moment is 2 products. We've got one which we call the business credit facility, and another product which we call the property investor credit facility. So I'll be walking you through both of these today. We'll start with the business credit facility. And what I thought would be good was to potentially give you guys a bit of a kind of overview of the landscape in terms of how we see it positioned. So what we see is, on one hand, you've obviously got the high street banks. You've got, your NatWest, your Royal Bank of Scotland, your Santanders. And typically what they offer to clients is they're relatively affordable. They typically always will be at the cheaper end of the spectrum in terms of rates. But a lot of the times they're relatively stringent in terms of the criteria, and they're also not very flexible, right? And it could a lot of the times be that they're relatively slow as well in terms of getting the financing arranged. Then you've got the sort of unsecured players where we see a lot of digital activity, right? We see the iWalkers, the funding circles. Here you've got the sort of inverse. They're relatively fast. They've got a seamless application process. But a lot of times they're quite expensive, right? We see APRs, north of 20% sometimes. And still requiring PGs. And then you've got the secured space where we see sort of 2 tranches. We see the secured space, which is still relatively expensive, north of 15% APRs, where you have, Credo, just cash flow, Fleximize. And then we ideally, and this is always a nice sort of chart that we're positioning ourselves on the right side, is that where we want to sit, right? We try to be fast, we try to be affordable, and we try to be flexible, with our average APRs in the book sitting at 6.9%. Right, and sort of disbursement times We'll go through that a bit later, so you'll understand exactly the process and the timelines as well. In terms of the product and how it looks, right? We're bucketing in here in 4 sort of sections. Let's start with the terms, right? It's the terms are minimum 25,000 up to 1 million, and we spread that over 10 years, right? So it's an amortizing product that amortizes over 10 years and has a minimum holding period of 3 months. The costs of this product, as we just mentioned before, an average interest rate of 6.9%, no fees associated to it, right? So we don't charge any setup fees, no ERCs, no legals, no valuation fees. And rates are actually determined by 2 factors, by LTV and by credit score. In terms of the collateral, we would take a first or second charge on residential property at 75% LTV, right? So typically we'll secure against the main residence, or we can secure on buy-to-lets via either a first or second charge. And the repayment structure of it is capital plus interest. We can also, Daniel Greaves can't hear me. I hope that the rest can hear me, but I'll just keep going in the spirit of time. For repayment methods, right, we've got 2 options. The standard default is a capital plus interest repayment, where whatever you have outstanding, and I'll dive into a little bit more of the structure of how that works. But for certain clients, we can also institute an interest-only period. If that's of need, we can accommodate for that in certain cases. Moving on to the structure of the product and why we call it a credit facility. It's a 10-year loan, essentially, or 10-year facility. But within the first 5 years, we're calling it a sort of flexi loan, because that is where the client is free to sort of draw and repay on their full amount as they please and as they want. And we essentially calibrate the interest payments and the capital and interest payments based on what they have outstanding, right? So here on the chart, you can see that, you know, if they've got 150,000 credit facility, but they only draw 50,000, we'll basically amend their repayments to only reflect what they have outstanding. So that's the first 5 years where we call it essentially a flexi period, where it actions as an overdraft effectively. At the end of year 5, what happens is the outstanding balance that you have drawn. So for example, on this one, you see on year 5, you've got 75,000 drawn at year 5. What happens at towards the last 5 years now is it actually converts into a standard term loan. And that essentially, that outstanding balance crystallizes, and it then amortizes, and you pay it off on a full repayment basis each month for the last 5 years. So basically, to keep it in easy terms, the first 5 years are an overdraft style facility, and the last 5 years are a standard loan, basically paid on. I'm using Chrome, Tony, by the way, Google Chrome. Or maybe we've got a couple of Daniels here, which is confusing. Chat. In terms of use cases, these are some common use cases. However, you know, any business use case to us is a viable option, right? So as long as there's a business purpose to it, we can look into it, right? So whether that's expanding a business, whether it's a management buyout, whether it's purchasing an existing business that has been trading already, whether it's debt consolidation, as long as there is obviously a use case to it that is business related, then we can utilize the product for it. In terms of the process, you can see it here. Typically, it all starts via the broker portal. So this is a portal that we've built. We've tried to make it very, very seamless and easy to use. The first couple of photos give you just a quick kind of screenshot and dashboard overview of how it looks. The way the process would work is that you would go on the broker portal. You would submit sort of the 5 buckets that you see here: client details, credit facility details, income details. We've structured this so this is very, very easy to do. There's just a couple of fields to type in. No documentation required at this point. And once you hit submit on the broker portal, we should have an indicative offer out to you within a couple of hours of submitting, right? And then from that indicative offer, we can obviously take the application further if the client wants to make some changes to the inputs. This will all be tracked in the dashboard view of the broker portal. And that broker portal will also serve as the portal where you can then upload the documentation required so that we can actually start the underwrite. And below here, you know, you've got a couple of timelines. This obviously varies based on the complexity of the case, but we see the, you know, case submission on the broker portal not needing to take more than 10 minutes. The indicative offer should be done within a couple of hours, within 3 hours. The underwriting would take anywhere between 1 to 5 business days. So this is, again, depending on the complexity. And within the underwriting step as well, we take care of the consent piece, right? So in the case of where we actually are a second charge, we have to get consent from the first charge holder. This is where we sort of try to build that whole process in. Then the last step would be the offer document signing, where you've got a bit of a legal process to it. You know, we need to action some solicitors, conveyancers. This we typically give another 1 to 4 days, and then once disbursement happens, that's immediate. That's an immediate bank transfer essentially. So from a sort of total time perspective, you're looking at, you know, best case a week to sort of 4 weeks, I would say. Now moving on to the last product, the property investor credit facility. It's in a similar structure here. The terms are the same. It's a maximum of 1 million, a minimum of 25,000. However, we spread this over 3 years. And the difference here is that it's not amortizing, right? It's essentially an interest-only credit facility that you have in place for 3 years. The cost for this, since it's interest-only, is slightly higher. So you've got starting at 0.66% per month, which equals out to about 8% per annum. And you've got a 1% arrangement fee on it. In terms of security, on this product, we only secure on buy-to-lets in a portfolio. So whereas on the business credit facility, we would also secure on the main residence. For the property investor credit facility, we're only securing on buy-to-let properties via our first or second charge, up to 70% LTV. And one of the soft sort of requirements here is that we require the applicant to have a minimum of 3 buy-to-lets already in their portfolio. This is just that we see this product sort of really fitting towards the amateur professional landlord and really being the perfect fit for them. And we sort of define that as an individual or as an applicant that has 3 buy-to-lets already in their portfolio. And lastly, repayment, like I said, it's interest only. So client can essentially draw and repay as and when they want over the 3 years. And the interest is only charged on what they have outstanding. The nice thing about this facility is that we do not charge any utilization or reactivation fees, right? So if actually the client has a use case for the product within the first 3 months, he needs to draw down 50,000, wants to use that, but actually wants to pay that down in 3 months' time to not make any payments, but keep the facility live because he knows that in maybe a year's time, he's going to need, you know, liquidity to draw upon relatively quickly again. That's fine, right? When the balance is outstanding at 0, we're not charging any utilization fees, but the client can still have the facility live to draw upon on a later date and get that sort of, you know, that liquidity, that cash basically that is in the background, which we disperse to him within a day of a request, essentially. So those are the terms of the property investor credit facility. And some common use cases as well would be, you know, purchasing a new property, anything that has to do again here with a property purpose would qualify for this product. Funding legal costs, anything that has to do within the portfolio, expanding the portfolio, etc. And lastly, I hope we're making time here. Similar process here again. So this is the same slide that I walked you through prior. The process is the exact same essentially for the business and for the property product. So that is it, guys. Thank you for listening. I hope this wasn't too fast, and happy to take any questions, obviously, as well.
Okay, we haven't got any questions yet, Daniel. Hopefully you can. There was one delegate, that was the Daniel that I was referring to. He couldn't hear you, unfortunately. He could see you, but couldn't hear. He can hear me, but he can't hear you. So we're just getting to log out and log back in again. Very strange, but
yeah.
Okay,
yeah,
so no questions have come up yet. No, Mike Hurd is typing. Hi, Mike. Hope you're well. Yeah, he's still typing. Just so you're aware, Mike Hurd is a broker I've known for a long time, who I think this might be his 3rd mortgage web show that he's attended, because you can attend as many of these as you want, obviously, because we try and get different lenders every single time. Well, I believe there might be 2 lenders at the next one who are speaking at this one. So it also depends on availability. Okay, so Mike's question is, can the business loan also be secured on a buy-to-let?
Absolutely, yeah. Yeah, Michael. So on a main residence or on buy-to-lets or on both, right? So we can have a combination of all of those to maximize the LTV, but certainly we can also secure on buy-to-lets. However, those would be always more residential buy-to-lets, right? So we wouldn't be looking into HMOs or multi-unit freehold blocks that have more than 7 in them. So as long as they are sort of residential buy-to-lets and a main residence, would look to secure on it.
Okay. I've got a couple of questions because we had some questions just in case there wasn't too many asked. So how long does the whole process typically take from application to disbursement?
Yeah. So I actually, there was a slide on that. So yeah, there's a couple of steps in it, and it will depend on the complexity of the case, but you're typically looking at 1 to 3 weeks, I would say, from sort of lead creation to disbursement, and factoring in sort of the consent process that a couple of banks, have different timelines for. We'd be looking at 1 to 3 weeks.
Okay. And another question I got here is, how do you assess affordability?
Yes. So affordability, based on the business credit facility, we've got a couple of, we look at businesses from a cash flow perspective, right? So we look to understand their cash flow picture as opposed to sort of their net income. So what we look at is bank statements. We sort of have tiered structures for the size of the business, right? So if the bigger sized businesses based on turnover, we would look to company accounts, and we would look to bank statements. However, for the smaller businesses up to 250,000 in annual turnover, we'll just look at bank statements, and we'll look at bank statements over a period of 12 months and essentially average out the cash flow over those 12 months to see if it's able to service the monthly repayments. Yeah, Tony, I think you're on mute right now.
Oh, I am on mute. I turned it on mute so I could speak to the two people in the room with me. Okay. What changes have been made to better understand auto valuations? They used to be tight.
That's a good question, Mike. So yes, we've got an AVM that we have in place that we've built essentially ourselves. So we don't actually do physical valuations. We do everything in house via the AVM. We are now on our second version of the AVM. So in the past, what we did is we built a lot of criteria in and sort of discounts in regards to the location of the property and how accessible it is to get to sort of major tier 1 or tier 2 cities. What we've done now is we've seen some flaws in that characteristic. So what we've done now is we've changed some of the criteria to actually reflect not location and proximity to a city, but more so the liquidity of an area, regardless of proximity to the city, but the liquidity of an area, meaning, what's the turnover of properties being sold in an area. And we're really looking at those data points, obviously with all the other data points that are available through all the other platforms, to get a smart valuation on the property. We understand that a digital valuation model is rarely perfect. So we do have a valuation team in-house that proves over every valuation. And we always would take a RICS valuation if the client has them. And we'll always try to kind of work with the client to make sure that the valuation is actually accurate.
Okay, don't have any more questions. Just our experience so far of Selina is that it's rare that someone comes into the second charge market with a product that's different. And this is very different. And it really is a very useful tool compared to what's out there at the moment. So it's something we're certainly taking advantage of. They've recently had someone join them, and I'm hoping he's still with you because I've not spoken to him in about 3 weeks, but ex-director of Shawbrook Bank on their second charge side. Is he still with you, Daniel?
The ex-director of you mean David Robinson?
Yes.
Yeah, of course. David Robinson has been with us.
Make sure you never tell in today's climate. Someone's with a company 1 minute, and
it goes fast.
You phone from him. Oh no, sorry, he left a week ago. So just making sure. So
David's still here. He's been great.
David's someone I've known for quite a while. Very good guy, very switched on, knows his stuff, and a big asset to Selina, bringing him on board. And of course, someone as we know him very well. And there's some new, and there are, I don't know how much I can actually disclose, but there are some very new and exciting things coming from Selina very, very shortly, I'm hoping. But I'm not allowed to say anything by the look of things because even Daniel's keeping his lips closed.
Yeah. No, I mean, we're happy to sort of give it high level, right? We've been always, the sort of concept of Selina was always with a view of going into consumer, right, and into the regulated space. So we will be offering and entering into the consumer space to offer the product, which is essentially the same as the business product, but for consumers and for consumer purposes, by September. So we should be FCA authorized by then. So we'll, in addition to the unregulated products, also will be offering a regulated product, which we're quite excited about. Yeah,
so we can't wait because we need all the products we can get at the moment, to be honest with you. So no, sounds good. Well, Daniel, thank you very much. That's great. I didn't think of Arnold Schwarzenegger once when you was talking, just so you're aware.
Yeah. Well, I've been working on it. I've really been working on trying to get rid of it, but it used to be a lot worse. So good to hear.
Well, no, it was good. It was good. So you didn't mention I'll be back once, which is good. So
yeah. I get to the chopper. Yeah.
So we're going to say goodbye to Daniel, and then on to
guys.
the next speaker. So I've got my glasses on this time, so I can actually see what I'm doing. The next speaker, which is Charlie Gregory from MFS. And delegates, what you should have in front of you is the document looks like this, which is a very much condensed version of their criteria. And I'm hoping that comes up on the screen. It's just a 2-page jobby. There he is. So you should be, you're basically looking for that. Their normal criteria is 8 pages, but I didn't want to send out an 8-page document to everybody, so we just condensed it down to 2. Charlie's currently, I think, flicking through my slides. So Charlie, hang on a minute, because I've got to introduce you first. So can you hear me, by the way? So Charlie Gregory, BDM at Market Financial Solutions. The reason I do this is that some of you might not be able to hear, might not be able to see the slides. So it's quite simply, it's just for those that can't see, I'll read out most of it and try and obviously just cover whatever we need to. So Charlie's BDM Market Financial Solutions, focusing on prime brokers and their clients with fast bespoke bridging loans. His background started in the state agency, more recently worked for a specialist buy-to-let mortgage lender for 2 years. Working closely with experienced employees at MFS, he is now an expert in all things bridging. We're going to put him to the test on that later with the questions, whether it be residential or commercial. Charlie already has well-established relationships with brokers, and we're getting a bit of feedback from somewhere, so I'm going to turn my sound down slightly, just in case that's me. Oh no, that's someone reversing in our car park, sorry. Okay. Charlie already has established relationship with brokers, enabling him to hit the ground running, and although most of his MFS life is spent in lockdown, he can't wait to get out and meet and greet everyone properly when things get back to normal, don't we all? His interesting fact, I said we had a bit of an international flavour today. He was born in Paris, spent 8 years in Japan, but he can't speak a word of Japanese, which is lucky for us because we didn't what we want the presentation in English. And his favourite food is fish and chips. So there you go. So without any more waiting, what we'll do, we'll just switch on to Charlie's presentation, and he will then do his bit. I'm hoping that's it. Charlie, over to you. Can you see it? Is he frozen? Okay, Charlie's frozen. Oh, I do love these virtual ones. I really do. So we'll see. Hopefully he'll come back any second now. It's actually showing him as being live as well, but it's not showing his microphone come up. Charlie, can you just type into the message box at the bottom right corner if you can hear us? Okay, not a lot going on. Okay, so my 2 people in the room with me are now desperately trying to get him back. As I said, it's always technical issues that cause problems on this. No, there's nothing at all. Oh, it looks like the software has kicked Charlie out of the room. So we're just going to get him back. So in the meantime, if you need to make yourself a drink, cup of coffee, cup of tea, quick loo break, now's probably a good time whilst the techies sort out the issues. Yeah, we're getting nothing at all from him. He's gone. He'll be back in a second, hopefully. And just with Market Financial Solutions, just to let you all know, we are an accredited packager with them, which means they, if you put the business through us, which we'll go into in more detail later on, you get paid the same as if you went direct. But of course, you get our expertise within the bridging market and actually processing bridging finance. So, which I and my staff have been doing for many years. So, still nothing yet. Oh, he's back in. He's coming back on now. So. He's just been added on as a presenter now, so don't you just love these? I believe this software is Polish, by the way, so we can't. I can't even blame the Americans on this one, who seem to do all the other ones. Just being added on now. And Charlie's presentation is going to be a bit more educational, rather than what we try and get people to avoid is going through every single rate. I mean, we have had a couple of presenters so far who've literally just read their product criteria sheet, and it's like watching paint dry sometimes. So we do try and encourage people now to actually give a presentation that is more educational and gives more case studies, case scenarios that you can maybe identify with, rather than just saying, yes, our rates are 0.65% and because we can all read. But it's the bits, I like our presenters to actually give you the stuff that you probably wouldn't know, rather than just read what you've got in front of you. So we're still trying to add him. He's on as a presenter. So we do have a plan B on these sort of things. So what we can do is that if we can't get him back, I'll ring him and he will then talk over my phone, which will then, you'll be able to pick up what he's saying, and I will then click through the slides. So we'll maybe give it another minute or so and I'll get him ready. So Charlie, if you can hear us, Charlie, could you just type in the message box at the bottom, in the bottom right? No, this doesn't appear to be working. Right, okay. So we're now on to plan C, which is calling him. And if he then comes on in the meantime on screen, oh, there he is. He's back.
Oh, can you hear me?
Here is.
Yeah, I can hear you. Can you hear me?
Yeah, I can hear you fine. I can hear you fine. Okay,
perfect.
Lost a couple of minutes. So what I'll do, you take over, Charlie. I don't know how much you missed, but I just waffle for about 3 or 4 minutes.
No, that's fine. So perfect.
If you take over, if you can all hear Charlie, then great. If you can't, just let us know again. So maybe Daniel, if you can't hear Charlie, let us know. And I'll see you in about 15 minutes.
Perfect. Thank you. Right then, guys. Thanks for listening to me today. Obviously, as he mentioned, I work for MFS as a BDM, and I cover the southeast region. And today I'm just going to give you a little bit of an idea about what bridging is, and then I'll also include a little bit about how MFS can help. So what is a bridging loan? Quite simply, bridging loans are an alternative form of finance that are designed to help people bridge a funding gap. So you get immediate capital, you get the funds very quickly, secured against an asset, whether that's a residential property, whether that's a commercial property, or whether that's a semi-commercial property, with flexible payment terms. So there's 3 different payment terms that you can do. Rolled up interest, where effectively if you've got a 12-month term, you don't pay anything on day 1, you pay everything back after the 12 months and the term's finished. Or you can service the loan, which is effectively where you pay the interest back monthly, and then at the end of the term, you obviously pay back the full amount. The net borrowing, where you pay interest monthly, is normally a lot higher. So that's the benefit. That's the benefit for paying it back monthly. If you did roll up the interest, obviously the benefit is that you don't have to pay anything back monthly. Or you can do a part, so you can part service the loan and part roll it up. Right. Why using a bridging loan? So the main benefit to using a bridging loan is the speed in which the funds can be deployed, whether that's buying while selling another property. So you might have it where you've got a client that's in a chain, and unfortunately their buyer pulls out. If they've secured their onward purchase and it's their dream property, what a bridging loan can enable them to do is carry on with that purchase so they don't miss out on their dream property, and they can effectively then look to sell their property and rebuild their sale of their property without the time pressure. Adding a new property to an existing portfolio. So that can effectively just mean buying a new property to add to your existing portfolio. What it can also mean as well is if you've got a first-time buyer, first-time landlord, as you guys might know, long-term lenders aren't keen on first-time landlord, first-time buyers. If you were in a position to find a lender that was willing to lend to them, you're probably going to be looking at very high, expensive rates as well. So what a bridging loan can effectively do for that first-time buyer is bridge the gap. So if you have a 12 to 18-month term, the client at the end of the term is effectively outside of that first-time buyer bracket. So although it might look expensive for the first 12 to 18 months, at the end of that time period, they can then look to go on to long-term finance and at affordable rates. So it could actually work out cheaper for your client in the long run. Renovating of a property for sale. So if you've got developers that are looking to flip a property, buy a property, do a bit of work to it, and then sell it on at a higher value, a bridging loan can effectively mean they don't have to use their own cash. They can use a bridge to obviously help fund that. Auction purchasing. So this is one that we probably come across most often. Auction purchases. Sometimes there's very, very tight deadlines on when you need to complete. So you do need the speed and the efficiency that mortgages, long-term lending can't offer you. And likewise, again, with auction purchasing, the property might have a problem. Typically speaking, properties that are at auction, they have got problems, that whether there's short leases, or whether they're not in lettable conditions. So what a bridging loan can effectively do is help the client purchase that property quickly, then obviously help fund the refurbishment or lease extensions, which then puts the property into a lettable condition and a condition or a state that's they're able to then go on to long-term finance and get it mortgaged. Commercial acquisitions is effectively what it says on the tin there. If someone wanted to purchase a restaurant or something like that, a bridging loan can help get those funds quickly and help them acquire that property. So there's quite a few on here of what other projects do we help support. So I won't go through all of them with you now, but I'll just go over a couple of them. So at the top left there where it says residential investments, bridging loans can help for new build purchases, ex-local authority purchases, or buying from a receiver. To the right there, buy-to-let properties. What can we help do? So I've touched base on it, but it can help renovate buy-to-lets. It can help put extensions onto buy-to-lets as well. Oh, sorry, no, that was the wrong one. Buy-to-lets there, I meant first-time landlords, I mentioned it. Refinancing portfolios, or leaseholds that are 40 years or 40 years left or less. Obviously, long-term lenders aren't keen. I think it's maybe like 60, 70, if I'm right, in saying minimum time left on a lease. So what a bridging loan can effectively do is help do a lease extension, which therefore means that the property is then in a position where they can get the long-term finance. Bottom left there, refurbishments. That's where you can renovate or extend a property. Bottom just to the right of that is conversions. So conversions can be multiple properties to a single. We see lots of people that have a house that they want to convert to 4 flats so they can bolster their rental yields. A bridging loan can help in that scenario. Or whether that's single property, multiple properties, sorry, converted to a single. So an office block converted to a house, or whatever that might be. At the top right there, it says semi-commercial. So that can be a restaurant, a takeaway shop with a flat above. Some long-term lenders aren't keen on takeaway outlets or anything that might have bad comments from valuation from the valuers. So bridging loans, it's a lot more flexible, and the commercial aspect doesn't really matter with us. We can have a look at it. To the right, commercial properties. So that can effectively just be office blocks, bookshops, whatever the commercial aspect might be. Auction purchases. So again, I've touched base on that. Can get the money very quickly for a person to acquire the asset at auction. Overseas. So we lend to expats. We lend to foreign nationals. I've actually got a case study that I'll discuss with you a little bit later on a situation that we had similar to a foreign national. But again, overseas trust setups we're okay with, or offshore companies looking to sell a property to an onshore company. That's again absolutely fine with us. So how does it work? When you apply for a bridging loan, the lender effectively adds a charge to the property using it as security. So you've got 2 different types of charges, a first charge and a second charge. So a first charge is effectively where you either are putting the first charge onto a property, so you're the first one to put the charge there, or if a property is, for example, unencumbered, because there's no active charge on the property, you are effectively the first charge on it. So an example of that is a mortgage. A second charge is where you're effectively adding a second charge to a property that's already got one on there. So if someone's got a property that's mortgaged, they don't want to redeem that mortgage, but they just want to take out some more capital from their property, they can look at doing a second charge. So again, here, it just gives you an example. If a property was repossessed, for example, the first charge lender's charge has to be redeemed before the second charge lender, just because it was placed on the property first. So the process, there's 6 nice and easy steps, which means bridging funds can be deployed very, very quickly. So I think we typically around 3 to 10 working days for a bridging loan to be drawn down, which is very, very quick. Step 1, the loan inquiry is received. So we haven't got any application forms or anything like that. You can effectively come directly to myself for BDM, or you can go to an underwriter. If we look like we're happy with the case, we can issue an indicative term. The indicative term effectively just gives you an idea on the costs, so what the rate's going to be, the valuation, and a couple of other bits of information as well. If your client's okay with that, that's when we will then take the case to our credit committee team. If they sign it off, we can effectively issue you the decision in principle, and the client the decision in principle, which is just a little bit more which is more confident than the indicative term. It means that our credit team have effectively signed it off. So if the client's happy with the decision in principle and they want to proceed, we then go forward to doing the valuation, and we do ask for a commitment fee from the client. The commitment fee is fully refunded on completion of the funds. So valuation is instructed. Step 5, the lawyers issue their paperwork. And subject to the valuation and the lawyers' paperwork and all their findings going through without any problems, step 6 is the drawdown of the funds. So as I say, 6 nice and easy steps, which means that the funds can be out very, very quickly. And that's what we're always saying when we go back to how quickly and the speed at which funds can be deployed. So what should you consider? With us as a lender, the exit plan is very, very important. We feel like you have to be responsible when you're lending. The borrowers have to have an exit strategy to show how they're going to pay off the loan. As a lender, we don't want the client to default. As a broker, you obviously don't want the client to default, and definitely as a client themselves, they don't want to have to default. So the exit plan is very important, and we can sometimes decline a case if the exit plan doesn't look feasible. Because it is very important. So the exit plan can be sale of property, refinance, or whatever it might be, but we'll look at that very, very closely. Management of the loan. So the borrowers just need to ensure they're prepared for any unforeseen costs, especially those that could arise during refurbishment projects. So just to give you an idea on that, obviously, if someone's borrowing some money with us to do a refurbishment and they've effectively budgeted themselves without any surplus cash, what happens if your client then runs into an unforeseen circumstance like dry rot, or just something that means that they're going to have to spend a little bit of extra cash? Make sure that they've budgeted in for that and they have got some funds for those unforeseen circumstances. Choosing the correct lender. So there are hundreds of lenders in the bridging market, so choosing the right one for your project can be difficult. Obviously, I can only speak on behalf of MFS, but myself as BDM and the underwriters, we do work very, very closely with yourself and your clients. If you prefer us to speak to them, we can do, to make sure that we're offering them a service that's satisfactory effectively and getting them to their end goal, whatever that might be. So why choose MFS? Obviously, I've mentioned it a few times because it is one of the biggest selling points, but speed is a big factor, speed and service. So we will respond to every inquiry in a 4-hour time period, no matter how complex the case might be. In-house funds, as well as multiple funding lines, means that we can make a quick decision on various criteria aspects. I think that's, again, a very important one to touch base on. Some lenders, long-term lenders or even short-term lenders, only have access to one funder or a couple of funders, which means sometimes it might feel like it's a tick box exercise. And if it doesn't meet the criteria, or if the minimum income's £10,000 and they've only earned £9,000, they can't look at the case. Because we have multiple funding lines and also our in-house funds, if the asset's strong, if the exit strategy makes sense, and the case overall makes sense, we should be able to come to an arrangement and be able to offer the client something. So we will lend 75% gross of the 180-day market value. Just given the pandemic at the moment and the crisis, we are currently at 70% as a maximum. However, we're hoping that will go back up to 75% imminently. But whatever the client's needs, just get the inquiry to us and we'll be able to give you an idea on what we can do. So heavy adverse credit is also accepted. I think this is also a good one. If a mortgage lender is turning down your client because they've got a hefty CCJ or they've got bankruptcy, whatever it might be, a default, we can look to help clear that adverse, put them onto a term of 12 to 18 months. And then at the end of that period, mortgage lenders will be able to look at them, and again, at more at cheaper rates and more realistic rates. Yes means yes. You probably hear that quite a lot. But again, I can only speak on behalf of MFS. And when we do say yes, we do really mean it. Some lenders underwrite the case on the back end. And there is a little bit of a flaw on that, because if you've done all of the work on a case and then you're ready to complete, but unfortunately something's found at underwriting that they're not happy with, you've effectively wasted all of your time. So at MFS, we ask for a lot of the information at the start of the application, because that means when we do say yes to it and legal's instructed and valuations are instructed, we effectively mean yes, unless anything catastrophic comes up at legal stages or valuation stage. We will endeavour to do our best to get that case to completion. So these are a couple of case studies that we've had recently that I'm just going to talk you through. So £500,000 loan. The client was in lockdown and they needed a first charge. So our client was stuck in lockdown in Italy, which posed challenges when it came to completing their property purchase. So the circumstances were the client was in lockdown overseas, a deadline was imposed on completion of their purchase, and long-term lender that they were looking to use just couldn't complete in time. So the MFS solution was solicitor was allowed the legals to be completed via Skype. These documents were then couriered to our solicitors. The valuation was completed whilst taking into account all the social distancing guidelines, and we delivered the funds in less than a week to meet the imposed deadline. So there's a really good example that just shows you that the funds that the client was looking to buy their dream property, and the long-term lender just couldn't, unfortunately, help facilitate that. So the bridging lender just enabled them to go in there and secure that property that they wanted. So I've got another one here, commercial property. So £1.2 million loan, multiple properties on a second charge basis. So when our client had a valuation come in lower than expected, we had to produce a solution to allow them to move forward. Now I can put my hand on heart and say that I can bet good money on it that a lot of you here have probably had problems when it comes to valuations with down valuations. It is incredibly frustrating, but obviously we want to move forward and try and find a way to solve the problem. So the circumstances, a low valuation on a commercial property, needed to restructure some finance somewhere, not able to pay off the competitive first charge that was already secured against the property, needed to move quickly. So the MFS solution was we use other properties within the client's portfolio to help bolster the purchase. This allowed the sale to complete as well as the refinance structure. We delivered the funds within a week to meet the client's deadline. So again, it's just highlighting the fact that it happened very, very quickly, and it basically meant that we were able to save the client's purchase. So for more information on the industry, we're constantly posting reports and blogs and case studies. There's lots of links on our website. We're also on LinkedIn as well, constantly posting and reposting stuff just to keep everyone up to date on the industry, because as you know, it's obviously fast evolving, fast changing. But I think that is about it. So yeah, thank you for listening.
Thanks, Charlie. I did that final slide, by the way. I didn't say the one that says any questions. So
Oh yeah,
that wasn't on your presentation, was it? So if anybody has any questions, if you don't, then we've already got a couple that we can ask that we've got here. So first question, I have a second charge deal going through. Is this something you would consider?
Yeah, so obviously, as I mentioned earlier, second charges is absolutely fine with us. We can do second charges on a main residence as well. We are an unregulated lender, so it does have to be for business purposes on a main residence, but it can be on a buy-to-let investment as well.
Okay. Second question we've got, make sure it's nothing been asked by any delegates. What do you ask for in terms of fees?
So in regards to fees, there's no application fee that we ask for. It is effectively the arrangement fee, the valuation cost, and then obviously it needs to be the legal work as well that they need to cover.
Okay. We have no questions from any delegates. So, and we are, unlike last week, where at this stage it was actually, I think it was 20 to 12 when the first speaker finished. We're running ahead of time today. So,
wow.
I haven't got any questions, which is good. So, Charlie, thank you very much. And delegates, what we'll do are 15-minute. Oh, Martin Howard's typing something. So let's just see, just in case it's a question. Thanks, Charlie. Okay.
Thanks, Martin.
Absolutely. Thanks. So yeah, Charlie, thank you very much. Very educational. Just really the sort of thing we need. So that's great. What we'll do, delegates, is that our 11:15 break will be at 1 minute past 11. So we'll come back at 11:15, if that's okay. So ignore the time on this slide because obviously I can't anticipate when that is. So I'll probably just try and draw a 15 instead of a 30. But Charlie, thank you.
No, thanks very much, Tony.
See you in 15 minutes. Okay, welcome back, everyone. On to our third speaker. Delighted to have one of our biggest supporters at our roadshows, Andy Virgo from Lendinvest. And again, apologies that my slides are taking a bit of a while to load. We've really no idea why, because these are normally lightning. So what you should have received from us, hopefully this will be the third bit you'll find, with the, if I can find it, the one that looks a little bit like this, which isn't loading up yet. There you go. It looks a little bit like that. So just on to Andy's bio and his interesting fact. So Andy joined Lendinvest from InterBay Commercial July 17 to assist with development of Lendinvest's entry to the buy-to-let sector. Previously a senior BDM within the OSB group, Andy worked as a commercial mortgage broker with Krissy Finance and established a property finance brokerage in 2006 after a stint with NatWest Bank in their real estate team. Initially charged with product development alongside broker management, Andy took on the role of head of key accounts when Lendinvest joined forces with the industry's mortgage clubs and networks. After winning the NACFB's Best Buy-to-Let Lender Award in 2019, more on my view of awards later, Andy was subsequently promoted to Director of Buy-to-Let, thus responsible for the development and subsequent success of Lendinvest's Buy-to-Let proposition. I'm going to add to that, actually, it's rare that you see a lender launch from scratch, something from scratch, and it's so successful. It really has been, and I think a lot of that is down to Andy not blowing smoke up his you-know-what, but a lot of that has been down to Andy. He's worked incredibly hard. He turned up to one of our roadshows once, having the day before actually fallen asleep on the motorway because he was on his way up and hitting the barrier. So he was working incredibly hard. His interesting fact, and some might be surprised, but Andy once broke his leg in a swimming pool, which I'll let him explain. I don't think there was alcohol involved. Andy, over to you.
Thank you, Tony. Hi, everyone. Yes, I was about 5 years old. I had a Ladybird book of learning to dive. For anybody who's old enough to remember the Ladybird book of range of books, it said, sit on the side of the pool, put your feet on the bar, lean forward, and away you go. That's you learning to dive. Little did they say that you shouldn't drop your leg behind the bar. Your leg breaks and you're underwater and your dad has to wade through the pool to rescue you. So yes, I broke my leg in a swimming pool. Right then, on to Lendinvest. Tony, you need to upload the slides. Oh, hey, brilliant, thank you, as if by magic. So yes, my name is Andy Virgo. I'm going to talk to you today about our buy-to-let proposition, specifically. Just a bit of background on Lendinvest as a business, though. We were established in 2008 as a bridging lender. New to the market, 3 guys in a windowless office in London. Took a long time to get off the ground, but as the years have progressed, bridging has become a massive part of Lendinvest. We're probably one of, if not the biggest bridging lender at the moment, and our current bridging proposition is top of the drawer. And we are extremely busy on sub £500,000 bridging deals. About 5 years ago, we brought somebody in from Barclays, a guy, Steve Larkin, who had been focused on the development side of business for Barclays. And as a team of 1 to a team of 16, Steve has established our development presence in the industry now. And as such, we probably complete circa £50 million a month of combined bridging and development lending. Buy-to-let is my baby. Buy-to-let's my thing. Buy-to-let is what I'm interested in most. And I joined specifically to help set up the proposition, which we launched in November 2017. It's been very successful. The proposition's grown. I'm going to tell you a little bit more about it now. But it's important to work out, in order to work out where we're going, we need to tell you where we've been. So just a bit of a recap on the year. We've all been part of this phenomenal year of weirdness. So back in January, we were flying. The industry was busy. The competitors were numerous. We had a wonderful buy-to-let proposition where we had quite some momentum. We were regularly completing 80% loan-to-value deals. We had £3 million advances on large HMOs and multi-unit freehold blocks, and interest rates were starting around about the 2.89% mark. We really were in for a good year. We expected to probably lend in the region of about 650 million this year, as things were sat back in January. Then I was out in Egypt, and it all started kicking off in Italy. We're hearing all sorts of things. This was sort of end of February. We were hearing all sorts of things about what was going on in the world, how Italy was struggling. We arrived back at Gatwick, and we're in the baggage reclaim area with some people with masks, some people without masks. But there were flights coming in from Genoa, from Pisa, from Rome, and Spanish flights as well. And we were all congregating there together in the passport control and baggage reclaim. So I got back to my desk. I worked from home, and meetings were getting cancelled. Brokers were cancelling meetings left, right, and centre. So mid-March, I didn't really see anybody. I've literally, war councils were being convened. People were looking at what we're going to do. We're a fintech company. We specialise in using technology within our business for our deals, which we'll come on to in a minute. But also as a business, we've managed to work from home throughout all of this. But in those early days, it was just, let's do some quick testing. Of course, everyone was out filling the cupboards with toilet rolls, which was now quite ironic. And then, of course, 23rd of March, that was it. Lockdown. Some lenders were struggling. Some lenders didn't have access to funding. We pulled a rabbit out of the hat. We literally, on the Friday, 21st of March, we securitized £280 million worth of buy-to-let loan book. That enabled us to hit lockdown with a full bank balance of money to lend and an empty warehouse. So it was perfect for us. We couldn't have timed it any better. So through May, we kept lending. through April and May, we kept lending. We had 248 people working from home. It was all very much business as usual for us. It was just very different business in that there were so many meetings being convened over Skype and Google Hangouts and etc. Zoom. We kind of refreshed our proposition in May, having previously restricted our loan to values down to sensible sort of 60-65% to see what was going on in the market. We were obviously charged with a higher cost of funds at that time, but it was a sensible thing to do to protect the bank. So we kept the applications coming in. The valuations were being stacked up and stored, ready for when the valuers came back out again. And effectively, we were able to keep the business ticking over, albeit 60% of the business was on furlough. And then what happened? We arrived at today. So 23rd of June, we organised our latest and announced our latest proposition. We very much wanted to understand, though, what the new world looked like. We're all calling it the new normal. It's working out what the new normal is. Our competitor landscape's different. Borrower requirements are different. There was a hell of a lot of pent-up business there from earlier in the year that we started to see immediately. Landlords were asking for 80% loan to value straight away. They were asking us to invest in student lets. But we have to be sensible as a lender. We have to be responsible. We were getting so many phone calls and so many inquiries on payment holidays that took quite a lot of our time and resource. We're not a bank-supported lender. We are not regulated by the PRA, which in one hand gives us a lot of advantages in the market. We can cut some corners when it comes to some of the portfolio stress test requirements and things. But ultimately, it means we're not supported by a bank. We can't go to the government for any support. So we weren't able to get any cover for our payment holidays. But as such, where you had something like 40,000 payment holidays at Kent Reliant, 60,000 payment holidays at Vida, I think we had about 104. So we were a new lender. We've got a sizable loan book, nowhere as big as those guys, but in proportion, percentage-wise, we managed our payment deferrals, obviously previously known as payment holidays, to the best of our ability, which ultimately just keeps us in business. So we came back with a proposition that was, quite close to where we were previously. I talked about January interest rates starting at 2.89. Here we are now. We've got interest rates starting at 2.99. We didn't want to initially work with new builds and large HMOs and multi-unit freehold blocks. Those properties were going to cause us all sorts of issues because of if you. Well, from the HMOs and the MUFBs, if somebody gets COVID in one of the flats or rooms, then it could spread. Equally, it could be quite hard to find tenants. So in the early days, we did restrict what we were doing, but gradually we have relaxed our criteria. We're now back lending to new build properties at 70%. We're back in the small HMO market up to 6 rooms, large HMOs up to 10 rooms. So from 7 to 10 rooms, we'll use the investment valuation basis for HMOs. Multi-unit freehold blocks, hot off the press, coming out, agreed yesterday and coming out next week. We're going to be increasing our maximum loan back up to 3 million on multi-unit freehold blocks. So that's going to be announced next Tuesday. So whilst we were trying to work out what the new world, what the new market, what the new normal was, what did we understand? What did we discover? Well, the first thing we understood is that landlords were looking for leverage. They were looking to build a hunting fund, an amount of money from remortgaging their investment properties so that when they did find opportunities to buy property potentially in a downward turn economy, they would be ready with cash and deposits. So we did find a lot of landlords were remortgaging properties. But when it actually came to the statistics, as we sit here today, there are more purchase cases going on than remortgage, so purchasers overtaken remortgage, which is quite strange, because the whole, we wonder if that's pent up business from Q2. We think that the stamp duty changes are obviously key. That's going to be something that we're very much looking forward to seeing an increased number of applications for, and we're here to support those landlords. Valuations were a right pain. So we found that people who were remortgaging were over-egging their value of their properties. So people remortgaging were saying that their property was worth more than the valuer was coming back with. The valuer, though, had very few comparables. So in the early days, it was quite tough to understand what was going on with the valuations, because they were up and down. Purchases were pretty much quite straightforward. Purchases were on par with advertised sale prices. So people were kind of advertising their houses for sale at the right price, but asking a little bit too much for them, or overestimating the value on remortgages. New build properties went down in value quite quickly and quite severely. We initially saw a downward turn of 10% in new builds, possibly a link to the fact that some of these first-time buyers were not able to use the money that they'd saved. They've now been using to keep themselves afloat during any furlough period, maybe, not using that to purchase property. So new build properties, we did see a real downturn on the values. But the best thing that we could do is just embrace these green shoots that were coming and work as hard as we can to make sure that everything that we're doing in the background is centered around service as well as price to boot. So we identified, obviously, that our target customer is the professional landlord, somebody who's looking to secure leverage. Leverage is king at the moment. We're seeing that our 75% loan to value products, we've got 2 on 5-year and 1 on 2-year fixed rates. Those are our most popular products. People are looking for leverage. Our average loan to value across our loan book in our last securitization, so across nearly £300 million worth of business, was 68%. We're now looking at something closer to 72%. As a lender, we need to get that down. So we hope more people take advantage of 65 and 70% loan to value pricing. Hence, at those 65% loan to value rates and areas, we're quite keenly priced, 2.99 at 65%. But 66% of what we're doing now is on our 75-year fixed rate products. We were uncertain about the size of the business, size of the opportunity, the size of the market. So when we came out on the 23rd of June with those 75% products with the little sunshine beside them, they're badged as our summer specials. We didn't want to go mad and overload the underwriters and the case managers. We didn't want our service to suffer. Considering we're working from home, we're now generating applications 4 times higher than where we were immediately after the lockdown. So we're very much able to cope with volume, even though nobody is in the office. But those summer specials, they're available until the end of August. We're going to review what's going on in the market then. They were initially market leading. I'll be honest, the foundation team repriced their 5-year fixed a pay rate product, dropped it by 10 basis points and took some of our business away. And Precise have now come out with their own, not summer special, but summer sizzler. So there's growing competition now, excuse me, there's growing competition now amongst lenders in that 75% loan to value sector. We didn't want service to suffer, as I said. We have made sure that we continue to use everything that we can to automate the process wherever possible. Buy to let is about securing market share. It's not about making a big profit. It's about doing more business as quickly as possible. We need to automate what we do as much as we can, whilst remaining a business that underwrites manually, because no two deals are the same. They're all pretty quirky, but there's an awful lot we can automate. There's an awful lot we automate already, and there's a lot of work going on now to automate further parts of our process internally that's going to allow us to speed up our turnaround of applications. Prior to lockdown, we were getting applications in and out to formal offer within 14 days. 65% of our cases were going to offer within 14 days. We will return to that stat as soon as people start submitting applications properly and start remembering to include salary, income details, and the portfolio spreadsheet. But we'll deal with that afterwards. For now, all applications are online. Everything's done via e-signature. You can be signing your mortgage application or your formal offer on your phone, on your laptop, on your iPad. In terms of identification, we don't need passports. We don't need proof of address. We just need a client to log into a link we send them to on Fido, which allows them to take a photo of their passport or a photo of their driving license and a selfie. And the two are sufficient for us to understand the ID. A bit like when I arrived back at Gatwick, it's the biometrics of someone looking at your face and linking it to your passport to make sure your passport is legit and you are the person in the passport. All valuation fee payments are made online, and we are doing all we can to make sure that landlords understand that we're here for them for the long term. Originally, we were going to call this an umbrella limit. So we were going to contact landlord or allow landlords to approach us to say, do you know what, I want to work with you in the long term. How much will you lend us? A bit of a hunting fund. We're going to rename that to appetite statements because Shawbrook already have umbrella limits. And we didn't want to steal that. So we're going to rename it to appetite statement. And we're going to make an announcement on that next week. And that's initially only going to be available via a select number of brokers, of which Tony's team at the Specialist Hub, even though they don't know this yet, it will be announced on Tuesday to them next week that they're going to get access to be able to provide an appetite statement to landlords. So it's important for you to understand when you would consider using Lendinvest. If you're using any of these lenders here, then these are the lenders that you need to perhaps stop and think about whether you need to be talking to Lendinvest as well. So here we are with a few names that are popping up again. Pepper have previously been remortgage only. They're now back to purchase and remortgage. Vida are obviously still closed, but they have managed to securitize recently, so they'll be back in the market shortly. You've got Keystone and Zephyr with very limited appetites. Foundation are being quite aggressive in that they are now repricing, and I think there's some new stuff coming out from them today. Lambay have repriced recently. Aldermore are there in the background for some quirky, weird and wonderful deals. Fleet are very quiet and restricted in the amount of funding they have, while we have Kent Reliance and Precise that historically have been quite quiet and haven't sharpened their pencil until Precise's current summer sizzler because they've been struggling with the amount of people working from home and the volume of business coming in. They need to get back into the office quick. But these are the lenders that you need to be looking at and thinking, do you know what? It's not all about rate. So when you look at us in sourcing systems, when you look at us in comparison to these other lenders, Precise, then Foundation, they have slightly cheaper pay rate products than us, but they don't have £150 valuation fees. They don't have 1.5% application fees, and they don't have £500 cashback towards legal costs. So be prepared to look at overall cost of borrowing, not just the headline rates. So to recap, leverage is key. We are very much here in the market assisting people buying and remortgaging property, be that residential investment, houses, flats above commercial, small HMOs, large HMOs, multi-unit freehold blocks. We are going to make a change next week to our stress test on our pay rate product. What currently we stress 140 at 4%, we're going to change to 100 and 25 at 4%. So people are going to be able to get more leverage on that, and that's going to be announced on Tuesday. So the rates are still market leading, but it's also about the overall cost of borrowing. The cost of borrowing, the overall loan to values. We're not back to 80%. We're not going to be that for a while. It's going to be a voyage of discovery still for the next couple of months. Summer specials are there. They're not going to be withdrawn. We've kind of ascertained that the market is not as big as we expected it to be. There's going to be a bit of acceleration from the stamp duty changes, but as it stands today, the market has not returned to the highs of before. We're not going to get overloaded with cases. So the summer specials remain until the end of August, and who knows what we're going to do beyond there. And like everything we do, we're very much on a mission to keep things simple. You'll see a lot of things coming out from us this year around how we're trying to keep things simple. Everything from the application process to using open banking. You know, why ask somebody to provide us with umpteen reams of bank statements when we can just log into their banking via a secure FCA regulated link to immediately see what their financial position is, and that's why we are accepting applications from people who have had bounce back loans and are on payment holidays, because using open banking means we can see exactly what it is we are dealing with in terms of a customer's up-to-date credit position. I agree with Tony. Tony's going to talk a bit later on. We always talk about awards. Some are more worthless than others. The NACFB awards were held in December 2019, and on our 2-year anniversary, we won the best buy-to-let lender. So from nothing to best buy-to-let lender, voted by brokers who deal with us as brokers. I will take that award, thank you very much, and value that honestly. So if anybody has any questions, please shout.
Somebody is trying to type a question, Andy, but it's not coming up for some reason. So as always, we've got some questions that here's one I prepared earlier. So how are you treating payment holiday deferral requests, and how is that affecting your lending moving forward for borrowers that have taken payment holidays?
Yeah, this is something, a bit of a moving feast, isn't it? I'm getting all sorts of emails from brokers and reading in the press about lenders not supporting people who have had payment holidays. There are some saying that they're supporting people with payment holidays, and then they're asking rafts and rafts of questions around the outside. We are very much a lender that will do what it says on the box. So we are not only honouring the high loan to values, but we're honouring the supporting of people who have taken payment holidays, as long as their financial position is solid and is safe still. A lot of people took these payment holidays or payment deferrals just in case. You know, by virtue of the fact that we received, 1,500 applications or more for payment holidays, but have only actually granted 104, that means that a lot of these people were doing it just in case. So we can see from the application by using online banking that the up-to-date position from a financial point of view is strong, and we're able to support those borrowers. If they're struggling, if they're not earning income, hopefully they're not making applications for mortgages. And if they are, it's not responsible, and they are making applications and they're not earning money, it's not responsible for us to lend.
Okay, next question. I've got to take my glasses off so I can't remember it. How do attendees access your buy-to-let proposition?
So everything we do, we suggest brokers and people listening today contact your team, Tony. You do an awful lot of business with us, and as such know all the shortcuts, the quirks that we as individual lenders have. We suggest that people take advantage of that opportunity to allow you to do all the work, and for the broker to then in turn earn exactly the same proc fee as if they came direct. Okay,
and just to add, weirdly, one of the underwriters at Lendinvest, related to in a very strange way. So yeah, it's one of those. Yeah, but okay. One last question, which is, when do you think you'll be returning to 80% LTVs?
Yeah, so this is a weird one, and you know, I genuinely don't believe that that's even up for discussion until Q4 this year. We've got to see what happens with house prices. We've got to see what happens with people that are coming out of furlough. We've got to see what happens in the winter with the potential possible bounce back of the virus. There's a lot of unknowns at the moment. So from a lender's point of view, when you think about it, if you take a 75% loan to value product, you add a fee on top of that, you're going to end up close to sort of 77% loan to value. You don't need property values to come down too much before you're in trouble. So 80% loan to value is off the table for now. Won't be around, might not be around this year, Tony, but later in the year at the earliest, but it does depend.
Okay, 2 questions are now popped up. This question is asked, this was Amar Bra who asked this. We want to do a remortgage on a house that is converted into 2 units, but it's on one title. Is this possible? Absolutely.
We would just class that as a multi-unit freehold block. So maximum loan to value on a multi-unit freehold block is 70%, Amar. But absolutely, you can make an application for a house that's converted into 2 units on one title. We would just class it as a multi-unit freehold block.
Okay, and this isn't so much a question, but more of a statement. This is Mike Curd. I'd love to use you. However, there's always something in criteria that kills the deal. I hope the new environment puts us all in a better position. The banking profile will certainly help.
That's great. It's great. It's great feedback, Mike. And it's the sort of feedback that we like. The good news is, and I don't know when you last tried to deal with us, but at the end of last year, we employed a brilliant lady by the name of Jean Closey. Jean Closey came to us from Shawbrook. She is our director of underwriting for Buy-to-Let. And since last October, Jean has been going through our criteria. As I say, and as Tony's intimated, we've been around for not even 3 years, yet. So what was our criteria initially when we came to market has changed vastly. There are so many changes to our criteria that we have produced a special criteria guide. We used to have a product and criteria guide combined. The criteria was getting quite complicated and wide, so we've produced the criteria guide, which Tony can furnish you with. And we have fortnightly criteria meetings where we actually sit down and talk about product, criteria, appetite, process. So we're very much looking to do what we can. I will guarantee, because of the role that I do, I guarantee that I have, or I can confirm that I have analysed the criteria of all of our peers, and where we are able to compete or better them, we currently do. Where we can't, and there's reasons behind that, for which we apologise.
And Mike, I'd probably add, if any cases you think are Lendinvest, then give us a call. As Andy already mentioned, you're doing the same as if you went direct. You can charge the same fees, you do whatever you wish. But again, maybe our contacts are a little bit stronger than possibly yours. And there's certain things, and there's a couple of cases. I'm not going to go into the details of the cases because Andy probably wouldn't want me to. But there's happened a couple of cases where we really have been able to do something that was initially would look like a decline, and we've turned them both into completions. So. But okay, if there's no more questions, glasses back on just to check. Okay, and Mike has said he has a case like Amar has mentioned, so we'll talk to me later. After 1:30, Mike, please, if you would. That'd be great. So Andy, thank you very much. Brilliant as usual. We'll then move on to our next speaker, and I'm hoping she's actually now, because we're running early, she'd actually, I think, gone down the shops possibly. So I'm just going to do the introduction bit first of all. So our final lender speaker, our 4th speaker, is Krissy Salmon from InterBay Commercial, who is actually our BDM, but we've not met her yet because she only became our BDM on I think it was the 1st of March, because our previous BDM went on to pastures new. So we met her for the first time the other day when we tested the system. And again, you should have received in the post, and just in case these take an age to load up, 2 documents. Look a little bit like that. You can see those. Yeah, there they are. They come up on screen now. On to a little bit of detail about Krissy. She is a senior business development manager for InterBay Commercial. 15 years experience financial services, working with brokers and clients in the specialist commercial market. Previously worked for One Savings Bank, trading brand Kent Reliance for intermediaries, 2 years. And prior to that was with Shawbrook Bank in their commercial team. Her interesting fact, she once politely asked Graham Gooch to move to the side as a broker and she were having their photo taken at Essex Cricket Club. Graham thought that they wanted a photo with him and got closer, but she obviously told him to get lost, and because she didn't recognise him, and asked him to give them some space. So not as embarrassing as my cricket story, which I might one day actually announce on one of these shows, but because it's probably the most embarrassing experience of my life. But more of that another time, I think. So, Krissy, over to you. I'll just get your slides up and running. Can you hear us, by the way?
Yes, I can hear you fine, Tony. Thank you. Can you hear me okay?
Yeah, absolutely fine. No problem. So just get your slides up and over to you.
Well, first of all, thank you very much for the introduction and the sharing of my embarrassing fact there. It was either that or I like pickled eggs, so I wasn't sure which one to go with. Thank you, everybody, for staying with us and listening to my presentation here today as well. I just want to run through some bits. So first of all, I'm going to start with who we are. So my name's Krissy. I'm the Senior Business Development Manager for InterBay Commercial, as Tony has just said. InterBay are part of the One Savings Bank group. And for those of you that are not familiar, some of our brands include Kent Reliance. We also have Precise, who joined us in October of last year. We have InterBay Asset Finance, as well as InterBay Commercial, to name but just a few. We're experts in adopting a flexible underwriting approach to your complicated deals, be that single buy-to-lets with complicated ownership structures, whether that's a multi-unit freehold block or a house of multiple occupancy. It might be a semi-commercial, or it might be a portfolio loan of multiple securities. We pride ourselves on reviewing each of your cases on their own merits and really do try and find a lending solution for you and your clients. So let's have a look and see what kind of things we can do. We split our criteria down into what we would consider a smaller buy-to-let, which is a single freehold property, which could be a multi-unit freehold block up to 6 units or a HMO up to 6 bedrooms. I'm not going to read every point on the slide because you guys can do that for yourselves, but I'm just going to pull out some of the key things that I'm seeing on my desk quite regularly at the moment. The kind of borrowing entity seems to be quite topical. I heard a statistic earlier on in the week that something like 70% of all new applications come in a limited company. I can't verify that stat, but it would certainly resonate with what I'm seeing on my desk. So you'll be pleased to know that obviously we can lend to limited companies, but that doesn't have to be a special purchase vehicle. It could be a trading company. So we're seeing quite a lot of development companies holding onto properties that historically they might have sold and choosing to let them instead, and that would be absolutely fine. We can also lend to trusts, we can lend to limited liability partnerships, as well as your standard single applications to individuals, as you would expect. Another area I see a lot of inquiries is around refinancing within the first 6 months, a day one remortgage. That's absolutely fine. We see a lot of investor clients going out to auction, buying for cash, adding some value, and then coming to us within that 6-month period for a term exit. The good news is we can look to capital raise all the way up to 75%, where we can see that they've added value, and that can be within that first 6-month period. You'll notice on the slide that we've got a minimum loan of 100,000 and a maximum of 1.5. There's a couple of things I'd like to add to that. Firstly, that our minimum property size is actually 75,000. So where you have a portfolio landlord and we're able to take multiple securities, they can actually be lower value properties and we can still achieve our minimum loan. And the 1.5 million is very much for guidance. So for the right clients with the right experience and the right security in the right locations, that 1.5 can absolutely be pushed to far beyond that. We put that limit in there just really to encourage you to engage with Tony and the team and myself so that we can have a look at the deal prior to submission. If we look at our larger or more complex buy-to-let criteria, so by that I mean your HMOs and your multi-unit freehold blocks that are 7 units up to 20 or 7 bedrooms up to 20, you'll notice that the loan to value comes down slightly, so we're at 70% maximum loan to value on those types of asset. We can consider student lets, we can look at HMOs that have got working professionals in, or whatever that kind of configuration might be. The multi-unit freehold block piece, that could genuinely be up to 20 units all on the one freehold title. Or it might be that your applicant has created leases and has leases in one entity and the freehold in another. That's absolutely fine. Or it might even be that they've sold some of those leasehold properties off and retained some of the flats on the original freehold, creating a block and block scenario. And again, that's absolutely fine. The concentration element doesn't need to be a concern if the valuer tells us that it's of no concern. So it's of no surprise on properties of this size and nature for a commercial lender, we are using investment valuations on properties of those types. A couple of things that come up quite regularly, and forgive me, these might have been topics that have been covered with other presenters today, are the bounce back loans and civils loans and what our approach and appetite toward lending to customers with those in the background is. And I can really say not much has changed, to be honest with you. If you've got a client that's taken a bounce back loan or a civils loan, that's absolutely fine. It wouldn't prohibit us from considering them for an application. The key here is that we won't use them as a source of deposit, but we've never used a genuine third-party loan as a source of deposit, so that's no change in criteria there. We're also asked quite a lot around furlough income and the income support for self-employed applicants. I think the key thing to bear in mind here is we're looking at the market rent or passing rent of the actual asset itself. So as long as that covers the debt service, there's no reason why if you've got an applicant that's currently on furlough or had furlough income in the background, that they wouldn't be considered for lending purposes with us. We are quite interested, as you would expect, on looking at how the client's able to meet any kind of potential void periods, but we would be doing that in any environment. Payment holidays is another topical question that's coming up quite a lot at the moment. We don't have a specific policy per se. We are looking at it on a case-by-case basis, but you can be expected to see the request for a couple of extra bank statements. I'm sure you're already factoring that into your fact find, and we're just looking to see if they made the payments, have they been getting rent, did they take a payment holiday, and what resources do they have to cover any potential voids on any new security that we're looking to lend on. We're also in the semi-commercial space. So what you can see here is that we are looking at loans up to 60% loan to value. Our minimum loan size has increased slightly up to the 150,000. And then we've got a max loan of 600, max property of $1 million. But again, as with the large complex buy-to-let, we do have a little bit of flex there. So if you've got a good quality asset and an experienced client, please do still engage in Tony and have a conversation around those cases, because we can look at them. The key considerations when we're underwriting a semi-commercial case is the fact that the affordability is still based on the residential element only. So we're excluding any rent from the commercial. So that means to achieve our 150,000 minimum loan size, you are going to need to see rent from the residential uppers of a minimum of 800 per month. We're also doing a little bit more due diligence around the actual commercial element itself. Now, it is still a commercial investment, so that's not, you know, deep dive, but we are looking to see that it's been trading throughout the pandemic, whether that's via online or takeaways, and, you know, diversifying from what it was historically doing. And we're just checking the kind of sustainability and viability of that tenant. The good news for you is we do that as part of the agreement in principle. So when we issue terms, you know that we've got an appetite to support that case through. And on the semi-commercial cases, we will do a full pre-valuation underwrite. So you know categorically at the point of valuation that the bank is happy to lend, subject to it coming in at the relevant value and so on. We are a lender that really does partner with brokers who are specialists and focus on sectors of the market. And we see firsthand how investors change strategy. Lots of different situations create opportunity in the market, whether that be a change in regulation, whether that's a change in taxation, or even the current pandemic that we're going through at the moment. We genuinely believe at One Savings Bank that these areas do represent areas of growth in the market. They were considered growth areas pre-COVID, and they're still very much areas where we're seeing growth in the market now. As a lender, we're not able to help with all of these, but we are able to help with many of them. But we really encourage you to get in touch with BDMs and lenders that can, you know, help you with all of these areas, which might help you and your firms going forward. What I would like to talk today is a growth area that falls within the buy-to-let sector, specifically houses of multiple occupancy, and just how we've seen landlords really shift toward more of a yield-based approach, as opposed to historically where they've had perhaps a capital growth kind of approach. I'm sure you'll all remember the changes to underwriting standards back in 2017 by the Prudential Regulation Authority. We really saw a shift in investor sentiment in the kind of properties that they were looking for, and how they were then approaching their new investment properties. So whether that was a change in the type of asset, maybe they were looking at lower value and adding some value to that property, maybe they were looking at using some permitted development right opportunities, maybe it was just a case of changing where they were looking to invest to obtain a higher yield, or also add in houses of multiple occupancy to their portfolio. So firstly, let's just recap on what a house of multiple occupancy is. The use of the term HMO at a basic level simply refers to a building where unrelated people live together and have some sort of shared amenities. So that's a kitchen or a bathroom. However, in England and Wales, the use of the term HMO has been incorporated into two separate areas of law. So that's planning under the Town and Country Planning Act of 1990 and licensing under the Housing Act of 2004. And we're going to come back and have a look at both of these. But why am I talking to you about HMOs today? Well, we did some analysis and we surveyed a large percentage of our broker community to formulate our Buy-to-Let Britain report back in 2019. And we identified that 51% of our brokers had been approached by their landlords specifically looking to diversify. Now, of that 51%, 56% of those quoted moving into HMO specifically. They're doing that, as I've previously mentioned, apologies, because they see them as an area whereby they can increase yield. Now, you know, historically HMOs were considered probably tatty student accommodation, but that market's changed. We are seeing a lot of professional sharers. We're seeing a move toward, I kind of call it like the friends effect, where people see, you know, a group of working professionals living together in that very much shared space. And we are also seeing the shift in where they want to invest. So whether that's moving away from London, which has historically done very well in the southeast, up into the north, maybe over into Wales, down into Devon, wherever that may be. Holiday lets being another area where I'm seeing a lot of inquiries at the moment, albeit unfortunately not something I can help with. So that's why we're seeing people kind of inquiring around them. As part of that analysis, we had a look at what regions have got the highest yield. So you can see there the Northwest at 6.2 at that moment in time. And we also had a look at where the fastest area of rental growth was being seen, and that was in the East Midlands. And I genuinely believe that all of these areas were being combined by savvy investors when they were seeking their next property investment and what type of property to look at. So I confirmed earlier in my presentation that the term HMO at a basic level simply refers to a building where unrelated people live together and share some sort of amenity, and that in England and Wales the term has been incorporated into planning and licensing. Unfortunately for us and for you guys, these two areas are not connected, and compliance with planning does not mean that licensing requirements have been satisfied, and vice versa. Obtaining a HMO license doesn't mean that you've got the correct planning in place. Now that's compounded because licensing and planning requirements are generally administered by local councils at a local level, but usually by separate departments that don't often talk to each other. So when we talk about HMO licensing, it used to be that it was for 3 stories, properties with 3 stories with 5 or more sharers from 2 separate households. But in October 2018, that changed, and we saw the removal of the 3 stories. So now any property that's got 5 or more sharers from 2 separate households are technically subject to licensing. We also saw the introduction of a mandatory floor size being introduced, which was, I've got a slide for that one for you, set at the levels that you can see there. Now that's impacted approximately 177,000 HMOs, whether that's that they needed to apply for a license for the first time, or whether that is that their large HMO has been operating historically as an 8, 9 or 10 bed or more, and now because of the room size requirements no longer is able to operate at that same level. So it's impacted a lot of landlords. What I also found really interesting is actually a child from the age of 11 onwards is considered an adult and therefore falls into those larger room size requirements. So why licensing? The desire to create a licensing system arose due to safety concerns connected with overcrowding in large privately rented accommodation. I love this picture. This is a genuine picture from a valuation that we have seen, but it was really there to drive out rogue landlords. So it was introduced to ensure that landlords of HMOs are fit and proper people or employ managers who are, that each HMO is suitable for occupation by the number of people allowed under the license, and that the standard of the management is adequate. High-risk HMOs can be identified through licensing and targeted for improvement. And there are lots and lots of things that really do fall into that licensing and that your landlords need to take into consideration. For example, refuse collection, making sure their safety certificates are up to date, making sure they've got smoke alarms, so on and so forth. Planning is the other key factor that impacts houses of multiple occupancy. The Town and Country Planning Act have categorised use properties into what they call use classes. So you can see here, C3 is our typical residential dwelling. So where I'm sat today in my kitchen, in my bungalow, in a C3 property. I'm often asked, do I need planning permission to change use to a HMO? The general answer is yes, you will always need planning permission to change use of a property to an HMO. However, it might be that the General Permitted Development Order allows you the use of permitted development rights to move from your C3, which is our family dwelling, into C4, which is the use category given to small HMOs. So that's properties with 3 to 6 unrelated individuals that share a kitchen or a bathroom. What it is worth noting, though, is if the number of occupiers is to be 7 or more, there is no such permitted development. And therefore you do need to have a planning application. Each individual council has the right to remove permitted development, okay, by what is called an Article 4 direction. Many councils have passed such a direction for example, popular student areas like Canterbury, Bristol, Bath, Bournemouth, for example, just to name a few. And in these areas, you specifically need planning. So you really do need to be asking your applicants, you know, where are you buying? Do you know if it's subject to planning? Is it subject to licensing? Who are you going to be renting it to? Article 4 areas do need a mandatory licence. And often councils will want to restrict the number of HMOs in the area. So planning for a conversion to house and multiple occupancy is not guaranteed. Different lenders have different rules and policies on HMOs, so please check with your BDMs, get in touch with your lenders. Try and think of your client and their lifelong journey rather than just the deal sat on your desk. It really does help in the long run. Local knowledge is key, you know, really understand your local areas. Do you have student areas? Do you have areas near hospitals? If you've got areas that have got new Article 4s coming in, it really, really does help and adds value to that interaction with your client. So there are lots of different lenders out there who can help, but for example, a lot of what we see at InterBay are first-time landlords looking to move into the HMO market, which we absolutely can support where it is a smaller up to 6 bedrooms unit. We work on a best rent approach, so if it's a 6-bedroom HMO, we will instruct a valuation to be done on a best rent basis. If it's a larger HMO, a 7 to 20 beds, as I've already mentioned, or multi-unit freehold block, we will go out and do a commercial valuation or an investment valuation for the client. If it's that the property needs a small amount of light works, it may be, it could be done straight on a term loan, or it might be that it needs to go via a bridging route. I had a property recently where it only needed some fire doors adding. Well, that can be done in a relatively quick period of time, and it will allow us to go straight to a term loan because our condition just asks for it to be tenanted within the first 30 days. So just to summarise, HMOs are increasingly popular for landlords looking to diversify their portfolio. If it were easy, everybody would be doing it. HMOs genuinely can provide better yield and security for your landlords. However, they do come with more stringent regulation and rules. InterBay commercial specialists in HMOs and can help ensure the smooth running of cases. HMOs are advice rich, which always require the help of a broker. Stay educated and in contact with your specialist commercial finance teams. I hope that helps. If you've got any questions, now is your time. Thanks.
I'm switching my mic back on. I'm getting a bit of feedback. So, okay, so we haven't got any questions asked so far. So I'll just go on to the pre-prepared ones. So the first one we had, Krissy, was my landlord has an HMO with a license in place, but there's no planning. Are the license and planning application not one and the same?
Thanks for the question, Tony. No, they absolutely are not one in the same thing. So it's really important when you're looking at new properties that you check to see if it's got the correct planning, where that property is located. So for example, I've just mentioned Article 4 areas where it wouldn't necessarily be allowed to move under permitted development from a C3 to a C4. So I would always get that checked out early doors.
Okay, next question we have, I've got one. I have a landlord with a large student accommodation, which is a 6-bed HMO, but there are also 2 self-contained flats as well. It's all on the one freehold. Can you do this?
Absolutely, yeah. We see properties configured in this style on a regular basis. It presents us no problem at all. We would just go out and do a commercial valuation on that one, Tony. So more than happy for a nice mix match, if you like, of HMO and self-contained flats.
I know you can do them because we've recently had one offered. So yeah, and
fantastic.
A very useful product it is as well. And then Martin Howe. Hi, Martin. Hope you're well. Any sign of full commercial mortgages coming back, Krissy?
That's a really good question, and it's one that I'm asked on a regular basis. The sentiment of the businesses, we're absolutely committed to supporting bridging and commercial markets, and we will come back at the earliest opportunity. I think it's still a little bit too early to tell. I think we need to see the furlough scheme kind of come to an end and probably wait out a little bit longer to get some more valuation commentary, but it will come back. I just don't have a time frame for it yet, I'm afraid, Martin.
Okay, luckily, or it is luckily sometimes, but we do have some alternatives that we've gained over lockdown. So if you do have any commercial deals that you find it difficult to place, and just give us a call. Okay, so I don't think there's anything else being asked. No notes, nothing coming up. So Krissy, thank you very much indeed. Much appreciated.
Thank you.
Loving the room, by the way. Looks really nice. So
thank you.
I will wave goodbye to you, and then we'll go on to the final bit of the presentation. Good news, everyone, is that we are running early or ahead of time.